Picture this. The most powerful economy in the world isn't held together by innovation, productivity, or even confidence anymore. It's held together by something far less impressive. Debt. About $18 trillion of it. Not total debt, just the kind that's quietly propping everything up. And here's the uncomfortable part. If that support weakens even a little, the whole structure starts to shake. This matters right now because America isn't heading toward this problem. It's already inside it. Markets are calm, stocks keep climbing, headlines say soft landing. But underneath, the system is using financial duct tape and it's being pulled tighter every year. So how did we get here? For decades, the US government has spent more than it collects. That gap is covered by borrowing, selling Treasury bonds, IOUs backed by the full faith and credit of the United States. Normally that's not scary. Governments borrow, investors lend, everyone moves up, but something changed after 2008, and then it changed again after 2020. To stabilize the economy, the Federal Reserve stepped in. It didn't just lower interest rates. It started buying massive amounts of government debt, trillions of dollars worth. Think of it like this. The government writes an IOU, the central bank buys it, and pays with newly created money. That money flows into the system. Markets breathe, crises fade, problem solved. Except the IOUs never really go away. Over time, the Fed built up a balance sheet so large it stopped sounding real. About $18 trillion in combined assets and liabilities at the peaks. Treasuries, mortgage bonds, promises stacked on promises. This became the quiet mechanism holding things together. Cheap borrowing, low interest rates, asset prices floating higher than fundamentals alone would justify. It worked. Until inflation showed up. Inflation forced the Fed to reverse course. Rates went up, bond buying stopped, and suddenly the duct tape started peeling. Here's the math most people miss. When interest rates rise, old bonds lose value, including the ones the Fed holds. On paper, that creates massive losses. Not losses that crash tomorrow, losses that weaken trust over time. Meanwhile, the government still needs to borrow. But now borrowing costs more, much more. So the Treasury issues new debt at higher rates. Investors demand better compensation, and interest payments balloon. That's the hidden mechanism. America is borrowing to pay interest on past borrowing. Not in theory, in practice. And here's the irony. The stronger the economy looks, the harder this becomes to manage. Growth pushes rates up. Higher rates increase debt costs. Debt costs crowd out everything else. Defense, infrastructure, healthcare, even emergencies. So what's the plan? Officially, it's stability, gradual adjustment, careful communication. Unofficially, it's hope. Hope inflation slowly erodes the real value of debt. Hope growth outpaces interest. Hope confidence never cracks. Because once confidence cracks, the duct tape doesn't tear cleanly, it snaps. This is where hype and reality split. The hype says US debt is safe because it's denominated in dollars, because America prints the reserve currency, because there's no alternative. All of that is mostly true, and dangerously incomplete. Printing money avoids default, but it invites inflation. Suppressing rates avoids panic, but it distorts markets. There's no free option left, only trade-offs. Zoom out and the risk isn't a sudden collapse, it's something quieter, years of slower growth, more financial repression, fewer choices disguised as stability, a system that keeps functioning, but less honestly. And that's why this $18 trillion matters, not because it's about to explode, but because it tells you what's really holding the system together. Not productivity, not savings, not discipline. Just layers of promises, held in place by confidence, and a lot of very expensive tape. So the real question isn't whether America can pay its bills, it's whether this system can keep pretending it doesn't need to change.